So if you're in Sydney, just let me know you're in Sydney, in Melbourne, and Brisbane. Thanks, Anupam. I appreciate it. Thanks for letting me know. So I can see the comments, so that's a good sign. Okay, so there's more than 21 people watching now. Just let me know in the comments exactly where you're watching from. And the idea of this live is really just for you. So I know that you guys have been following this group, and I'm very grateful for engaging, and hopefully it's been giving you lots of value. The point of this live is just to give you more interaction and allow me to answer any questions. If they're stupid or if they're intelligent, there's no such thing. Just really putting it out there. I know as a new property investor, it's really hard to get the right information in an authentic way from someone that you can actually trust. I'm not saying that you can trust me, although hopefully you can. But I'm just going to be telling you everything I know based on what you're asked. So I can see that Fahim, I think that's how you pronounce it, you're joining from Melbourne. Welcome, Fahim. Julie Chang, thanks for making it. I appreciate it. From Brisbane. Vikas, good to see you, bro. From Melbourne. So just once again, I can see that there's 30 people on. Oh, I need to scroll down. There's everyone's commenting. Samrat from Sydney, thank you so much. Lutfor from Brisbane. Ashutosh, hey bro, from Sydney. Dan, good to see you from Sydney. Parminder from Melbourne. Rumana from Melbourne. Matt from Tassie, there you go. Heidi, thank you for joining us, Heidi. I've been seeing you commenting a lot from South Australia. Louise from Sydney. Sunil from Sydney. Tatsuya, that's a very cool name, from Sydney. Terence from Sydney. And Joshua, hey Josh, I think I spoke to you ages ago. Hope you're doing well, from Melbourne. Okay, so there's more than 30 people here. I think I'm expecting probably between 50 and 100, but I'm surprised there's 30 here, to be honest. So I've got a bunch of questions already from people who submitted them. So I'm going to start with that. And then, you know, as I go along, or even right now, just put in the comment section any comments that you have about what I'm saying, but also any questions that you have. And I'm just going to be trying to answer them as I go along. And if I'm seeming nervous, well, that's because I am. I do lives all the time, but this is a little bit formal, so it's a little bit off-putting. So I had a really good day today. I took my son to footy in the morning, little kickers. He can kick with his left foot now. And then I had a couple of strategy calls with potential clients, and then I had one client call. So that was my day, and now I'm doing this. Avinash, welcome from Melbourne. And I think let's get into it. So, okay, so Clarissa had submitted a question earlier around NDIS. So what is the deal with NDIS? If this is a question that you also have, let me know in the comments, and then I can sort of give you more nuance and any tailored advice. But Clarissa wanted me to talk about NDIS, the pros and cons. So I'm going to do that right now, amongst other things. So NDIS, it stands for the National Disability Insurance Scheme. And the whole thing with NDIS is that it's for folks who are, you know, needing that sort of housing. From an investment perspective, it sometimes appears to be a brilliant idea. The pros of NDIS are that you have much higher yield. So whereas generally in residential property investment, you know, we consider 6% yield, 7% yield, 8% yield quite good. In NDIS, you can get up to 10% yield, 11% yield, 12% yield, or a little bit less or a little bit higher, depending on the actual product. You know, this is a specialized product for folks who need it. So that's one advantage. It's got good yield. Everyone's chasing yield, so it seems to be a no-brainer in that perspective, but stick with me. Another pro of NDIS is that you can often get rental guarantees. So these aren't the type of rental guarantees that a developer would promise you and then they would load that into the purchase price of the property. This is a type of rental guarantee because you have a long-term lease, right? So a long-term lease means that you can actually be certain that you're not going to have tenant turnover and you're going to lose people. All right, so those are the two pros in my mind from NDIS, but there's a list of cons or drawbacks. So one of the drawbacks is the build cost. So you need to build this brand new in most instances, and because it's tailored for disabilities and other things like that, the build cost for NDIS product is more than what a normal residential spec home would be on a square meter basis. So what that means is that you're paying more for construction or building costs than you otherwise would have or ought to. So that's one of the downsides. The other downside is that banks sometimes aren't so favorable to give loans for this type of product because it's such a niche product. It's not proven yet in the Australian market, mass wide scale. The other thing is location. So unlike traditional residential property investment, you can't just go ahead and choose exactly where you want your NDIS house or investment property to be built, right? It has to be within the confines or particular areas where the need is there. And so if you happen to build in an area like Ipswich, let's say, for example, then your growth isn't going to be as spectacular as if you were in a genuinely high growth area. So you're limited in that way. The property management costs are that much higher. So normally property management costs in Australia and residential real estate are between sort of 6 and 9% kind of, ballpark figure. For this type of product, for NDIS, it's much higher. It's well above 10, sometimes close to 15%. So what that means is although you're getting the higher yield, it's being eroded by those extra property management costs. And then finally, liquidity. Let's say you you build the NDIS product, you have the tenant in for a 5-year lease, happy days. What if you need to do an emergency sell? What if your family situation changes? What if you can't afford the property anymore? You lose your jobs? Anything can happen. In that case, then you're kind of stuck with it, and there's huge break costs. And the secondary market to whom you would actually sell it is very limited, right? So you're kind of stuck with it to a large extent. So overall, Clarissa, I don't know if you're watching, but I'm sure you'll be watching soon or on the replay. Hopefully that answers the question. So personally, I think NDIS can provide good potential for really good yields, but from a growth perspective, it's not great. And even though it's good from a yield perspective, there are so many downsides that I just wouldn't recommend this for a new investor. If you already have 5 properties, then go for it. But if you have 1, 2, 3 properties, then I think the risk appetite is probably a bit too high. Or risk appetite for most people is a bit too low for the level of risk that NDIS provides. Cool, so hopefully that helps. I'm just going to read some comments out. So Yogesh is asking how to find a reliable source for supply and demand data of a particular suburb. How do we ensure about capital growth of a suburb except supply and demand ratio? So that's a really good question, Yogesh. So oftentimes I get asked this question, how do we understand all the data for a particular suburb? How do we actually understand that it's going to grow? So the answer is, there is no answer. There's no single website. Of course, everyone knows about these websites like Location Score, I think Boomtown, there's a few others, HTag. All of these sort of claim to say whether a suburb will go up or down in value, but the truth is that if you do statistical regression analysis, none of these websites have cracked the code. And I would love to say, just go to this one website and it's going to give you the clear answer. Even Location Score fails in that. For example, right now, Location Score is showing a lot of Tassie suburbs, towns, Chigwell and Hobart, for instance, as still very, very high. But the fact is that Hobart actually dropped in value for the first time. I think it was 2 weeks ago or something like that. It was only a week's worth of drop, but nonetheless it dropped. So none of those websites in and of themselves are very useful, but what you do need to do is you need to get 20 to 35 data factors, both quantitative and qualitative, from different websites, okay? So I don't look at RP data, I don't look at Residex, I don't look at CoreLogic RP data, APM, Price Finder, all of that stuff. I go to the raw source of the data and then take those factors, understand their trends, understand the relative weightings of the factors, understand the threshold beyond which a particular factor, like let's say average vendor discounting, needs to be below for us to say demand is high. Okay, so there's no sort of perfect formula or algorithm that's just going to pop out an answer, Yogesh. You do need to understand how to do it, and that's kind of how I make money. So hopefully that helps, Yogesh. Sharon, hi PK. Hey PK, is part of your program creating a long-term strategy for investment or more focused on data for purchasing? It's a really good question. This video or this live is really not intended to be a plug for my program, but you asked the question, Sharon. So regardless of the program or not, what every single investor needs to do, and yes, Sharon, this is part of the program, is start with a portfolio strategy. So what a portfolio strategy means is, let's say you have a passive income target of, let's say $100,000 in 10 or 15, yeah, let's say 12 years time, all right? So you're a mom or you're a dad, you have a couple of young munchkins, you're in your late 30s, maybe early 30s, early 40s, kids under 10, you know, you're sort of thinking about your retirement, you want to reduce your hours, you want to have some flexibility so you don't have to work for the rest of your life. This is where portfolio strategy comes in. So portfolio strategy means in order to achieve that $120,000 passive income target in 12 years' time, how many properties do I need? What needs to be their respective values on purchase and afterwards? What is the yield of each of those properties need to be? What is the sequence or order of those purchases, or what's the timing? How soon should we buy them? How spread out should they be? What are the assumptions that go into this? For example, our serviceability. How do we structure our long-term lending, tier 1, tier 2, tier 3 banks so that we can even buy the 4th property or the 5th property or the 6th property? All of this stuff, you know, which properties are we going to keep in the long term as legacy to hand over to our kids versus which do we sell? Because when you retire, you don't really want to have, you know, millions of dollars of debt. You want to be debt free. So you need to sell, in many instances, some properties to retire debt. So all of this comes under the banner of long-term portfolio strategy. And without knowing your long-term portfolio strategy, it's really hard to know where your next property fits into it. It's hard to buy that next or first property with intentionality, right? So hopefully that answered your question, Sharon, and yet that's absolutely the foundation of what I do. I'm sorry to pronounce your name wrong, Duai or Nugent. How to start out with equity only. For example, a paid off home. I know you asked this before as well, so I had on my list, so I'm going to address it right now. So it's a really good question. I know many of you will probably have equity, you'll probably have a bunch of you know, debt, you could say, because that's what equity really is, that you can access from your PPOR or even from an investment property. And guys, if you like anything that I'm saying, I'd love for you to hit the like button. If you're loving anything I'm saying, please hit the love button. Just show me some feedback. Otherwise, it's kind of like talking to a screen and I'm just looking at myself. So I can see there's more than 40 of you on here, but please just interact and I'd really appreciate it. Thank you so much. Yeah, so this is how you start. So if you have, let's say, $500,000 or even $100,000 in the family home, the very first step you need to do is go to a mortgage broker, an investment savvy mortgage broker. So what this means is you go to a mortgage broker and you have an initial conversation with them with respect to how much is actually available for you to take out. The number one myth that people think is that just because I have $500,000 or $1 million or $1.5 million of equity in my home, that I can actually access all of it. That's not necessarily the case. Equity is not free money. It's just debt. It's just recycling debt. You're refinancing that property and pulling out debt. You're basically just having a loan, right? And if you don't have an income, or if your income is very low, then the bank might not even allow you to recycle that debt or pull that equity out. We call it harvesting equity, right? So But if you do have that and the mortgage broker confirms that, then well, you're on your way. It's almost like you've got $100,000 of equity, and now you've got $100,000 in your bank account that you can play with, and literally you can do anything with that. You could go and book a trip to, well, not right now, but you could book a trip to the Maldives. You could buy a fancy car with it. You could, you know, do anything with it. It's your money. But at the end of the day, it's a loan. Okay, so if you're using it for investment purposes, whether it's property, shares, or any type of investment vehicle, it becomes tax deductible. So all the interest that you pay on that pooled equity becomes tax deductible. So that's how you start. And it's just like if I gave you $100,000, what would you do with it? Well, like I just mentioned in response to Sharon's question, you would need to start with a portfolio strategy and then a property strategy. You would say, okay, well, you know, what's the price point I'm targeting? What's the yield I'm targeting? What's my risk appetite? Do I want to be active? Do I want to develop, subdivide, renovate, do a granny flat, or do I want to be completely passive and just set and forget, you know, ride the capital growth, ride the positive cash flow, rents increase, I retire. You know, so that's the short-term property strategy. And then when that property goes up, you recycle that debt. Maybe that goes up by $100,000 in 3 years. You can take 80% of that $100,000, 80,000, and then that's your deposit for your second property, etc., etc. So hopefully that makes sense. Ravi, hey Ravi, how much deposit do you reckon we need to start with? So I actually have done a video on this before as well. So the amount of deposit that you need to start with is between $30,000 and $40,000. Oftentimes people think that you need $60,000, $70,000, $80,000 or even more. This is what I call the Sydney syndrome. It's just because property is expensive in Sydney, but property is not expensive everywhere in Australia. So for example, for those folks that I was helping about 4 years ago, buying in Tassie, you could get in for $30,000 in a place like Burnie, Romaine, Northwest Tassie. Matt, if you're still watching, you'll know this place well. You know, buy something for $230,000, $30,000 deposit plus a bit of, you know, transaction costs. Those same properties are now above $300,000. So you've tripled your money. $30,000 has gone to more than $100,000 in 4 years' time. All right, so you don't need a lot to start with investment property, so long as you're not building. Building costs more, right? As long as you're buying established, low maintenance property, you can get in for between 30 and 40 grand. So hopefully that helps, Ravi. Let me know, or if you have any follow-up questions, let me know as well. All right, guys, well, hopefully I'm not talking too fast. Let me know if you're enjoying this. Can you just comment in the comments if this is actually making sense, if you're getting value? There's so many questions here, but I'd love to see if it's actually resonating, if it's actually sticking. Otherwise it's just me pretending that I'm smart. Fahim, regarding stamp duty, are there strategies to cut this cost down? Well, I wouldn't call it a strategy, but definitely a tactic. So a tactic to reduce your stamp duty, I think many people would know this, is, you know, the stamp duty concessions for first homeowners and other things like that. You can just do a quick Google and you'll find all about that. The other thing to note with stamp duty, and the way most people get around it, is by buying new. So buying a block of land and then building on it. Now the difference between buying a block of land and building on it versus buying an established house is that buying a block of land and then building on it means that you're only paying stamp duty on the land, right? Stamp duty is something we need to pay in Australia when there's a transfer of an asset, like a car, from one person to another. So when the land is being transferred from the council or from a developer or from someone else to you, then you have to pay stamp duty. But because you're actually building the house yourself, you don't pay stamp duty because there's no transfer going on, right? So this is a way that, you know, especially if you're in a big stamp duty state like Melbourne, you can get sort of reduce your stamp duty, but 9 times out of 10, I don't recommend building or buying a house and land package or something like that, where you get that stamp duty discount from the developer. And the reason is, and this is actually a question that Julie Cheng, I think you're on here as well, Julie, you asked this in a previous post that I did. Should you buy new or should you buy old? You know, the age-old question in property investing, should you buy new or should you buy old? So the reason I don't recommend trying to avoid stamp duty too much is because it relies on you building new. And that is a significant sacrifice of capital growth. And let me explain. So hopefully you guys are all with me. There's almost 50 people watching, so just let me know if this is actually making sense. All right, so old versus new. Let's talk about it. Okay, so in considering how to get capital growth, the most important thing to understand is that buildings depreciate and land appreciates. Okay, it's just an accounting fact. Buildings depreciate, hence we have a depreciation schedule. And it's the land that appreciates because it's the land that's scarce. That's why houses generally outperform apartments, but let me get to that. So in considering how to get capital growth, let's say you had $500,000 to play with, and let's say you went out and bought a brand new house and land package. You know, you bought the land and then you're building, or you bought the turnkey solution. All right, so you think you're pretty happy. You know, it's new. There's a 7-year builder guarantee or warranty. You might have even been given a rental guarantee that's been priced into the purchase price, but let's just forget that for now. Now that seems good, but let's actually understand what's going on here. Because it's brand new, you've paid probably about $350,000 off the $500,000 in the actual build, right? These are just round numbers, right? And $150 for the land component, because naturally it's a brand new building, hence it's expensive, right? Now let's juxtapose that versus an established house. In an established house, it's still $500,000, right? You can buy either one of these. But in an established house, you are probably paying $150,000 for the building because it's established, it's old, it's not brand new. And therefore you're paying $350 for the land. All right, so both old versus new. The new you've paid $500, the old you've paid $500. But in the new you've paid $150 for the land, and then the old you've paid $350 for the land, because in the new the building costs more because it's new. In the old the building costs less because it's old. All right, so actually I'll try and make this interactive. What do you guys reckon will appreciate the most in 2 years' time, in 5 years' time, in 10 years' time, in 15 years' time? Which of these two options will appreciate, the new or the old? Just tell me in the comment section. The new one with the $150K of land component, or the old house, the established house with the $350,000 in land component, which will actually appreciate the most? All right. So naturally, if you sort of think about it, it's going to be, as a fundamental rule of thumb, it's going to be the established property, because buildings depreciate and land appreciates. Right? Exactly. Ajit, you got it. So, when you think about, I want to buy a turnkey solution, I want to buy a new house, it's new, it's kind of like what everyone thinks, including myself. When I started in property investing, I was going to buy an apartment in Chermside in Brisbane. Now, Chermside has had negative growth in apartments in the last 10 years, right? But that's just what we gravitate towards. Investment grade property must be investment stock that people try to sell us, but that's absolutely wrong. Okay, so coming back to the question, I forget who it was from, Fahim actually. Yes, you can avoid stamp duty by buying land and building yourself, but really it's in many instances a better idea to buy established. There's always exceptions to this rule, and I have a client, I'm not going to tell you his name because he's also a buyer's agent, But he's done incredibly well in the Werribee area. For those of you folks in Melbourne, you'll know exactly what I'm talking about. He started buying in 2014 in Werribee, you know, house and land package, I think. And, you know, every time he bought, he made like $50,000 to $100,000. And Werribee exploded between 2013, we're talking southwest Melbourne, exploded between 2013 and 2017, maybe. There's a bit of a tail into 18. And this client of mine who's a buyer's agent, he did phenomenally well, right? So he would probably, if he's watching this, he'd probably be thinking, PK, you're having a laugh because, you know, I've made hundreds of thousands of dollars doing exactly the opposite of what you've just said. And look, there's always exceptions to what I'm saying. But the reason Werribee increased was not because of hospitals, was not because of schools, was not because of train stations, was not because of all that. It was simply because the entire Melbourne increased, right? You can be the worst property investor, and I'm not saying my client was, by the way. He was being very strategic in which pockets he was buying, and he was buying in phase one, etc. But you can be the worst property investor and still make crap loads of money when the entire surface of the ocean lifts, right? All ships are elevated when the surface or the tide comes in. So I think I went off on a tangent a little bit, but hopefully that helps Fahim. Paul Cox, how do I find suburbs outside of Queensland that are cash flow positive and have capital growth potential? It's a really good question. I'd love to ask you right back, why are you looking outside of Queensland? That's not a leading question, I just want to know. But in terms of how you find them, I actually did a video on this as well, but the key sort of takeaway from that video was that first of all, what you want to do is you want to get a list of every single suburb. There's more than 15,000 of them across Australia. You want to get a list of every single suburb and their respective yields, okay? And then of those 15,000 suburbs, there will be about 3,000 that are statistically reliable, that the data we can actually trust because there's enough stock on market, there's enough listings, there's enough sales for the data to be, the fidelity to be high. And then what we want to do is we want to say, okay, which of this list has a yield of above 5 or 5.5%. Above 5.5% is a safe bet that it's a positive cash flow property after maintenance and after maintenance and after all of your expenses, but pre-tax as well. So you lose your job, it still is not affecting your ability to hold your property. So 5.5% or thereabouts is what you're looking at. And then what you want to do is, you've probably got a list of 100 suburbs or more. Then you want to apply the system that allows you to understand whether it will give capital growth or not. And capital growth, as we discussed just before, is determined by supply and demand. Okay, on the supply side, you have factors like a developable land supply, like building approvals, like stock on market, the percentage of renters, and on the demand side, you have things like online search interest ratio, you have things like average vendor discounting, you have things like vacancy, you have things like historical growth, you have things like, what am I missing? There's a whole bunch of job advertisements, incomes increasing, there's about 20 factors on the demand side. And then you just want to balance them out, okay? So, I mean, I can't give you a sort of straightforward answer that's going to solve all your problems right now, unfortunately. But that's the method that I use. It's a top-down method that we're scouring everything and we're optimizing for the best combination of capital growth and positive cash flow. You can also do the bottom-up method where you just focus on one pocket of a city like Adelaide where there's many positive cash flow opportunities. And then you just really try to understand two suburbs super well and really see if they're going to actually go up in value. And if it doesn't work, then you go to the next suburb and then you assess whether that's going to go up in value by applying data, by monitoring it, and if that's not going to go up, then you go to the next suburb. So that's more of a trial and error, that's more cumbersome, that takes a long time, you need to be on the ground. The method that I use and teach is more top-down, just based on data. So I kind of feel, Paul, that I wasn't super helpful in your question, but that's genuinely how to do it. It's not hard to find cash flow properties these days. I think probably outside of Melbourne and Sydney, probably 20-25% of properties these days are positive cash flow. But you know, there's a big difference between positive cash flow that gives you $2,000 a year versus $5,000 a year with capital growth to boot. Okay, so that's obviously the holy grail of property investing. But positive cash flow, I mean, let me try to be more giving and just give you some answers. Hope my clients don't mind so much. These aren't suburbs that clients, if you're watching, that we're actually investing in, but they're positive cash flow nonetheless. So somewhere like Chigwell in Hobart, somewhere like Romaine in Tassie, somewhere like I think Launton to some extent in Brisbane is still positive cash flow. We're not investing there. Ripley, Leichhardt in Ipswich, definitely not investing there, but positive cash flow. In Newcastle, it's getting a little bit harder, but sort of in the Hunter, you've got so many opportunities for positive cash flow. Places in Bendigo, you know, if you go out 10 kilometers outside the city in Bendigo, you've got, I mean, it's, you know, you're just swimming in positive cash flow. So there's no dearth of positive cash flow opportunities. I think people kind of big it up, positive cash flow, but it's quite easy. But what you don't want is to buy a property that gives you positive cash flow, but only $1,000 for the next 10 years. That's useless. All right, yep, equity is attached to debt. Yep, absolutely, Heidi. It's not free money, it's actually debt. And equity in itself is an asset. Absolutely, Heidi. Without equity, without recycling equity, it's very difficult to buy 3, 4, 5, 6, 7 properties, which is really what you need to develop that 6-figure passive income in the long term. Ravi, thanks, mate. Oh, yeah, appreciate it. Sunil, can we watch again later on in the group? Yep, so this video is going to stay on the group. The more people that comment, the more people that engage with the video means that all 4,500 people in my group, in this group, will see it. So share the love, it's going to remain there. And if you're watching not live right now, but if you're watching tomorrow, on Wednesday, or on Thursday, or a week from now, it's probably still going to be popping up on news feeds. Just hit the reply, just put a hashtag reply, not reply, replay. Comment replay in the video, just so I can in the future know that people actually watched this afterwards as well. Okay, so if you're not watching it live, just comment replay in the comment section, and that way I know that people actually got benefit out after the live session as well. Louise, yes, awesome. Sunil, how do we structure home loan to reduce tax, company, trust, etc.? Oof, all right, that's a good one. I'm not going to talk about it too much because I am not an accountant, but what I will do, I'm just bringing something up. I'm just going to go over some very basic things when it comes to structuring, you know, which ownership or entity structure you should be buying within. So this is something I teach, so I'm just out of respect for my clients, I'm not going to go into it in too much detail, but there's about 6 things that you want to be considerate of when thinking about, should you buy in your own name, should you buy in joint names with your husband or wife, your spouse, should you buy in a trust, a unit trust or a discretionary trust, or in a company structure, or in a discretionary trust with a corporate trustee, etc. I mean, there's a million different structures you could use. I think that's how Donald Trump doesn't pay any taxes, but I'm not trying to get political here. But there's 6 considerations, right? So first thing is land tax. Now, some of, own name, you don't pay land tax until a certain threshold, but the other things you do need to start paying land tax pretty quickly. Negative gearing is only available in your own name. You don't get the CGT discount if it's a company structure. Limited liability if you're in a profession that's particularly litigious, like if you're a doctor or surgeon or something like that. You want to be careful about buying in your own name. Profit distribution, once you are getting that $50,000, $100,000 passive income in the future, you don't want all the properties in your own name, for instance, because you'll be paying tax on that. And the setup costs associated with buying in a trust or a company can be cost prohibitive as well. So you want to be super mindful of that. So I'm not going to go into too much detail, but hopefully that gives you an overview of some of the considerations, Sunil. Ajit, all good. Land, yep, that's the one. Thanks for sharing. Yep, old, yeah, everyone got that right. Old, established properties, by and large, beat brand new properties every day of the week. Chin Fong, hey, hi PK from Singapore. Oh, that's awesome. Does your model look at the effect of climate change? Example, flash flooding, drought in suburbs to purchase. I know you asked this before as well, Chin, so it's a really fascinating question, and I must admit I'm not an expert in this side of property investing. I don't exactly know which suburbs across Australia are going to be impacted by climate change, whether it's rising sea levels or rising temperatures in the outback or whatever. I'm not so familiar with that, but what I can say is that there are various overlays that we want to be mindful and conscious of before buying a property. So for example, when buying a property, even if you're brand new, even if you've got no experience in buying property and you know almost nothing about investing, you should still think about 5 or 10 years down the line. And I don't just mean from a climate change perspective here, so stick with me. Let's say you want to buy a high cash flow, high growth property, but you have no idea of how to subdivide it, or you have no idea about how to build a granny flat, or you have no idea of how to split it if it's a splitter block. Still be mindful of those things, still be conscious of those things, because in 5 years' time, you might have the confidence, the skills, the experience to tackle something like that. And if you bought as your first property something that had potential, then you'll be thanking yourself down the line. That was my personal experience when I first started property investing. I didn't know anything. I was about to buy an apartment in Chermside. But then sort of 8, 9, 10 years later, started doing residential development, now commercial development, medical centers, all that sort of stuff. So how this relates to climate change is you have to be very, very, very conscious of overlays. So if there's a bushfire overlay on the block or on the lot that you want to buy, then that automatically precludes 99% of development potential. All right, so that bushfire overlay is just going to become more and more exacerbated as climate change fructifies and becomes more of a problem in the world. In terms of rising sea levels, look, I can't say I know a whole bunch about that, but if you're buying next to the ocean or something like that, it's probably a good idea just to investigate that with a geotechnical engineer or at least the town planner or the city council. Sorry I wasn't able to be super helpful, Chin, but maybe if you want to share your thoughts from a Singaporean context, that would be cool. Terence, hey PK, can you visit investing in apartments again in Sydney? Okay, so let me be very, very clear. I do not recommend buying an apartment in Sydney. Okay, so I know so many of you have these chats every single day. So many people are seduced by these development companies and these property marketeers. They generally start with the name Positive or Freedom or something like that. And they're selling off the plan apartments, or they're selling you know, house and land packages. But even if it's an established apartment, apartments underperform houses on aggregate. That is the history, that is the data, that is the historical fact over the last 35 years in Australia. So that's a rule of thumb. Now, there's always exceptions, okay? There's always an exception to a rule. So what I generally recommend is that if you really, really, really want to buy an apartment, despite, you know, sinking levy funds, despite body corp and strata, despite not having a significant land value, then you should really focus on apartment blocks that are less than 3 or 4 stories high, that somewhat counterintuitively have no elevator, have no gym, have no pool, nothing that blows out the body corp. Just very old in style, kind of 70s flats on the ground floor that are scarce. Okay, a bit like villas or bungalows, or in New Zealand where I grew up, we used to call them flats. Because those still have some sort of land component, or there's still some scarcity and some character, those will do well. And look, there's plenty of examples in the inner western Sydney, out in the eastern suburbs towards Bondi. In Melbourne, there's plenty of examples of these sort of flats, 30, 40 years old, outperforming houses. So in Melbourne, the sort of dynamic is 5 to 10 k's out from the city, either way, around the clock. You know, if you can't afford that $1 million, if you can't afford that $1 million house, or that $800,000 house, you buy that, you know, $500,000, $600,000, $700,000 flat. It's a unit. It's technically, I guess you could call it an apartment, but it's on the ground floor, or maximum 2 stories high. There's no elevator, no gym, no extras, nothing to inflate the body corp, and there's scarcity. And those do incredibly well, oftentimes when the folks who want to downsize from their really nice building or really nice house, they downsize into one of these bungalows or villas. That pushes the prices up. And so it can be a good idea, but you need to be very careful. You need to follow the data in the right suburb and make sure that villas, apartments, flats aren't the exception to the rule in terms of what their demographic wants in that suburb. All right, so if apartments or flats or villas or bungalows are only 10% of the type of dwelling in that suburb, then you can kind of sense that there isn't a huge amount of demand for that demographic, for that type of product. You want that to be higher. You want it to be a typical thing, an average thing that an average person in that house, in that suburb, would actually want to use and live in. So hopefully that answered the question, Terence. A good idea, but very selectively. But if you're new or not super experienced in property investing and suburb selection, but also property selection and valuation, then I think a safe bet would be just to buy a house. And don't think that just because you've got less than 500k to spend that you have to buy an apartment. I just had a call today with a gentleman, and we were discussing this as well. So there's always possibilities for you to buy a house rather than an apartment. You just have to be borderless. Look outside your backyard. Julie Chang, hey Julie again, for the positive gearing apartment and townhouse, always better than houses, but for capital growth will be the house. How will you combine those types of houses for your long-term goals? So I think what you're saying is that houses will all... So I think what you're saying is positively geared apartments and townhouses will always be better than houses for yield, but for capital growth, it will always be the house. So houses, you're saying, will always outperform for capital growth, but apartments and townhouses will always outperform for yield. Not necessarily, if I can say that. In fact, the gross yield for apartments, for units, generally tends to be quite good, 5-6% even in Sydney. But the fact is that the net yield, which is actually the money that we get in the bank after all is said and done, after or net of body corp, sinking levies, everything like that, it kind of balances out to be very similar. It's just that gross yield is higher for an apartment, but it's not apples with apples, because the one thing that we're missing is the strata or body cop fees and other sort of sinking levies and things like that. So I don't fully agree, but perhaps that's your experience, and that's good to know. But absolutely every day of the week you can get positively geared properties that are houses, established detached houses that also go up in value. So I personally don't have, in my own portfolio, I don't have any townhouses or any apartments. I have attached houses, but freehold. But I always prefer houses because, for the simple reason, if nothing else, you can do stuff to it, right? So with a house, you can subdivide it, you can split it, you can renovate it really easy on the outside, landscaping. You can put a granny flat at the back if you're not in Brisbane City Council. There's so many things that you can do to add value. Property prices don't increase like this, they increase like this, right? There's big booms, there's periods of plateau, and there's periods that prices sink to a small extent or a large extent. Your portfolio always must be growing, and that can only be done if you also have value add potential. And that's really hard to find. Not impossible, really hard to find in in apartments. Once again, there's exceptions to that. Mermaid Waters and the Gold Coast, you can pick up an apartment in the high 200s, spend 20k on it, kitchen, flooring, paint, sell it for mid 300s. Even to this day, you can do that. So free tip, anyone want to renovate, anyone that's local to the Gold Coast or can manage the renovation using a property manager, I teach all this stuff, but if you can do this, Mermaid Waters, great price disparity between unrenovated and renovated apartments. So hopefully that brings you guys some value. All right. Thanks, Julie, for that question, by the way. Ajit, how about Eastern Heights suburb? If I'm not mistaken, I think you're referring to, is that an Ipswich? If that's the one that you're referring to and the one that I'm thinking about, I dislike Ipswich as a blanket rule. My opinion doesn't matter at all, but the data dislikes Ipswich. Eastern Heights has not really grown. The balance of supply and demand is quite even. I was just talking to a client about it earlier today. The stock on market is way above 1%, which means supply is high. There's pockets of issues with black soil and foundations of houses sinking. There's flooding issues around there. Yields are good, but the low socioeconomic sort of type of people or demographic means that tenant turnover is higher and maintenance costs are higher, which in turn means that landlord insurance is a little bit high. There's various reasons, but I wouldn't recommend Ipswich at all, either for positive cash flow purposes, because rents aren't going to increase, meaning positive cash flow is not going to increase in the future, nor for capital growth. But if the entire if the entire southeast Queensland, Brisbane and surrounds goes up, of course Ipswich is going to reap the rewards through no work of its own, but that's fine. Nicole Kerrison, hi, I'm a bit late. That's quite all right. This is going to stay up forever as long as Mark Zucks is alive, so you can watch this again. Loof Mata, hey PK, would you choose interest only or principal and interest? Great question. There's no right answer. If you want to build a long-term portfolio with 3, 4, 5, 6, 7 properties, you probably need to start with interest only, or at least have an interest only component. However, if you are up against the wall in terms of servicing, if you're thinking about how do I get that 4th property or that 5th property or that 6th property, then switching that next decision or next property to principal and interest may just give you the leg up with additional borrowing capacity, right? So what I mean to say is principal and interest is what bolsters your borrowing capacity relative to interest only. But of course, with principal and interest, it hits the back pocket, your household budget more because you're paying principal and interest, despite P&I loans, the interest rate being a little bit lower. These are just rules of thumb. There's always exceptions, but look, Loof, if you really want to be serious about a long-term property portfolio, then at some point you're going to have to go interest only. And personally, until I started paying my debt off, until I started consolidating my property portfolio, I was all interest only. But I was very fortunate that the income was between my wife and I was pretty good. So we were okay in terms of serviceability, but yeah, interest only allows you to reserve that surplus cash that you have. Instead of paying it down in principal, you reserve it and you allocate it, or you attribute it towards the next deposit, right? And then when that goes up, you're attributing the recycled equity towards the next deposit. That way you're leveraging and buying more and more assets instead of just paying one down. The more assets that you have, the more houses that you have, and they all rise at the same time, that's how you become wealthy, right? That's how you really significantly grow wealth, not just by buying 1 or 2, 3 properties and paying them off. There's nothing wrong with that. Everyone's got their own risk appetite. Everyone's got a different strategy. Everyone's different. Sleep at night factor. But if you really want to go hard, then you want to control multiple assets. The key word being control. You don't own them, the bank owns them, but you're in control. And as they rise, then in the future you can choose to sell 1, 2, 3 of them, use that cash, pay down the debt of the houses that you still own, and you're living with a property portfolio of 3, 4, 5 properties, debt-free, and you never paid principal and interest. Now that's the purest way to think about it. It's more complicated, but hopefully that helps, Loof. I'm getting a bit tired. There's 6 minutes left, so please, guys, if you're if you're enjoying this, please let me know. There's so many questions coming through, but I'd love to hear your comments as well and what you think about some of these questions. But if you are actually genuinely enjoying this, please give this a like, or please give this a love. If I'm making you angry, give me the angry face. That's okay to do. But yeah, please let me know what you think. Vinay, do you still predict 3 high-yielding investment suburbs to be Earlwood, Hurlstone Park, 5 Dock, or are there new additions as per your search? I think I made these comments a while ago. I'm not sure, but we addressed high-yield suburbs just before. So on the replay, you can go back to when we were talking about that. Ching Fong Hee, thank you. No, that's completely fine. Hey, Tom. Tom, best way to start transitioning from property investment to developing. Can you use equity from properties to fund developments? Yes, you can. So absolutely. I mean, equity is money. It's just a loan. So when you have a $100,000 property and it goes up to $200,000 and you take 80% of that, that's $80,000 in your bank. You can buy a Rolex with that, you can buy whatever you like with that, that's your money, and then you can use it, if you so wish, to start in the development process. I actually think someone was asking me, I've got this piece of paper in front of me, Hayden Wilson, so I don't know if you're online, Hayden, let me know. If you are, just comment right now if you are, or on the replay. Hopefully this helps Hayden. So Hayden was asking me how you develop, how you actually do development. So Tom, you can definitely use equity in your residential portfolio to transition into development. And then in a nutshell, Hayden, the way to start developing, and this isn't gonna really help you at all, but you start by selecting a suburb, and don't focus on 15,000 suburbs, don't focus on 5 suburbs, focus on 1 suburb. Get to know that suburb better than the back of your hand. And in that suburb, every time someone has done a development in the last 5 years, reverse engineer the numbers to see what the profit was. Okay, so if someone's built 2 townhouses in the back of an established house, find out what they bought it for, find out the subdivision costs, find out the council rates, the council contribution, the building costs, the marketing fees, the end sale value, and from joining up all these dots, you'll be able to see what profit they made. And I can tell you right now, being someone who knows this industry, 80% of developers aren't making money. This is a fact. You see cranes everywhere, you drive past, subdivisions, there's spec homes, townhouses. 80% of developers, I can tell you right now, are not making significant profits. They may look like it because they've got, you know, the fancy home being constructed, but they're not, because they failed to do one thing. Before you spend a cent in development, reverse engineer the exact profit to the closest 10,000, exact closest to 10,000, that existing developers in that suburb are making. And when you find a particular combination, a particular type of product where developers have repeatedly made money, you know, whether that's splitting a block and selling the land, or whether it's splitting a block, building a 3-bedder and selling that, or whether it's subdividing and putting a duplex at the back and selling it, subdividing, putting 2 townhouses, selling it, subdividing, not building, just selling the vacant land. You know, subdividing doesn't mean you automatically make money. The highest and best use of the land is what's going to make money. So find multiple, Hayden, find multiple times where a certain type of development has made money in a suburb, and then just repeat that, because there's no risk in that then, right? To Tom's point, you can take your equity, you can put it in, you know, get a couple of funders to your project. You know you're going to make money because it's been done before. The council will approve it. There is demand in that suburb for that type of product. The builder that you can use can be the exact same builder as the previous developer, because you know that they're good. They've done it before in this exact suburb. So just going to turn the fan on. This is how you make money in development. And Tom, I don't know if that helps, and Hayden, I don't know if that helps, but hopefully that you know, avoids a lot of mistakes. Don't shoot from the hip when it comes to developing, especially when you're using your hard-earned equity. Okay, here we go. I knew someone was going to ask this. Prabjit, hey, hi PK, how about buying investment property in Logan? I think I'm going to get some haters if I start talking about Logan, but Logan's a big place. Not all parts of Logan are bad. There are parts of Logan where people have made money. Daisy Hill is not a bad part of that Logan City Council area. So there are good parts of Logan, and then there are parts of Logan where, and here's my rant, every buyer's agent and their dog is getting clients into. Why? Because buyer's agents have a business model where the more properties that they sell their clients, the more money they make. And where is it easiest to buy properties that are positive cash flow? Logan, right? The story of being between Brisbane and Gold Coast in 20 years' time, that's going to combine. There's going to be this massive city, hospital upgrades, 30 kilometers from the CBD, migration from Sydney, Melbourne into Brisbane, great weather, yet to boom after the Sydney, Melbourne booms, all, you know, that whole narrative. Easy to sell a property in Logan. Stock on market is huge, so there's plenty of listings, really easy to churn out the volume game. But here's the thing, 95% of Logan is not investment worthy, because even though it looks like yields are high, even though it looks like you can get a 6% yield, the socio-demographic makeup means that the tenant turnover is higher, vacancy rate is somewhat higher because of tenant turnover more than anything. Tenants can be disruptive, which is just a massive stress, headache. Parts of Logan are off limits in terms of what some banks will actually loan you for. Whole bunch of reasons, right? So, and to boot, capital growth has been non-existent for the last 10 years, and in my humble opinion, based on the data, my interpretation of the data, in the next 5 years, capital growth will be, you know, let's say weak, if existent at all. Now, of course, if entire Brisbane goes up, then Logan will benefit just like Ipswich, but I don't think that's going to happen. I would love for it to happen. I live in Brisbane. I have property in Brisbane, but I don't think the entire Brisbane will go up. So, hey guys, it's 8 o'clock. So, I mean, there's so many questions. Philemon, thanks for, up to 4 stories, no lift. That's a good formula. Nicole, Sunil, Julie, Gaurav, Heidi, Jay, Anupam, Tuhi. Apologies, I can't get to all the questions, and I know there's others that wrote into me before as well, but hopefully that was really, really useful I'm really grateful that all of you were here. There was almost 50 people here at some point, and I know that if you hit the like, love button, if you comment below, you let me know how you experienced it, whether you actually liked it, whether it was useful. The more you engage, then Facebook algorithm is just going to blow this video up, and it's going to reach probably all 4,500 people in this group. And that would be awesome, because I'm just trying to be as authentic as possible. I'm trying to be as truthful as possible. I'm trying to be as straight up as possible. Just trying to bring honesty back into property. It's really hard to get rich quick in property. It's really easy to get rich slow in property. So if you have questions, please continue to ask them in this video, and I'll use that as stimulus for future posts, for future videos. But lastly, just let me know if you actually want more of these. Okay, so I can see that a lot of people are online. Even though I'm kind of rambling on, there's still almost 50 people watching, so that's pretty awesome. But just let me know, do you want more of these types of videos? Do you want more live sessions? I'm thinking every week might be a bit too intense for me, but every 2 weeks or something like that. Just leave a yes below, or a yes please, if you do want more of these types of live sessions, or if you don't, leave a no and an angry face, okay? So once again, thank you so much, and of course, you know, this is my chance to plug my program. I'm not going to talk about it, but if you want to work with me, let me know. All right, guys, have a great Tuesday evening. For those of you watching in Sydney, Melbourne, it's pretty late. Thanks for being up with me. I'm going to go put my son to bed now. Catch you later. Bye. How do I turn this off?